the whole role of us as CPAs is to get the word out and say what's going on. The reality is, which was kind of funny with what these changes were doing, is we were told we were making a lot of noise. And I kind of laughed. I said, yeah, we're making so much noise because apparently people are going to be paying us more, and we like to fight against our own pay increase. But that's what's going to happen. I mean, the reality is a lot of fees are going to be going up for everybody. So where did this start? So it started with rhetoric, plain and simple. Okay. In the July 18th, 2017 minister's letter, it kind of reads like a class warfare manifesto. Language like, but there is a sense that some may be getting a better deal than others. And it starts by making sure that we all pay our fair share of taxes with no exceptions. The government is taking steps to address tax planning strategies and close loopholes that are only available to some, often the very wealthy or highest income earners at the expense of others. That was the letter from finance. Not something I'm used to seeing. Usually we get stuff from finance, it's very boring, it's legislative, we got 27 pages of legislation, which in my world is a lot to get at one time. So the language I thought was somewhat offensive and unnecessary, because from what I can look at in here, I'm not sure that you're all a bunch of tax cheats. Pretty sure that a lot of you are probably just following the law and paying the right amount of tax, no more, no less than you're required to under the Act. So the loopholes are not loopholes. They're deliberate tax policy that our government has implemented decades ago, with much of it coming from the 1966 Royal Commission on Taxation, which is also sometimes referred to as the Carter Commission. So the language that is used like this alienates you and I. Language utilizing like this in saying that they're targeting farmers and small business is just not acceptable. So where's this coming from? Well, there was an economist that wrote a paper in 2015, which was much of the campaign. And so I just kind of give a little bit of background as to why we're even talking about this stuff today. So Michael Wolfson, from I believe he's from the University of Ottawa, he wrote a paper back in 2015, which became part of the Liberal Party election platform. Many mainstream economists, including Jack Mintz, kind of a friend of the conservative side of things, were dismissive of Wolfson's research and methodology. And as a tax practitioner, I was shocked at the number of taxation errors in his analysis. These July 18 proposals, to my surprise, picked up on many of Wolfson's issues, and you can see he's been in the Globe and Mail and dealing with that as well. So the first one that affects everybody, not just farms, but anybody if you have a relative that's in small business as well, is income splitting, or what they've been calling on the media income sprinkling. Frankly, I'm not a big fan of that term. I tell my kid he's sprinkling on the toilet seat again, so I'm not sure I like to use that one, but income splitting is the one I'm a little more comfortable with, so I'll probably refer to it in that sense. So these proposals were accompanied by draft legislation, and usually by the time we get something into draft legislation, just so you know where we're coming from, it's pretty close to being the letter of the law. It is the letter of the law, it just hasn't been passed yet. And so in the past, when we've dealt with things like when they changed the rules for people who have passed away and they wanted to wind up estates within a shorter time frame so that people didn't have this long, huge tax deferral, there was a consultation period. They said, here's what we're looking at. We're looking at estates, and please give us some feedback. That was about 6 months worth. And then a few months later, they came out with some draft, got more feedback. The whole process took about 1.5 years, and they eventually settled on a thing after back and forth. Did we like all the proposals? No, but we could live with them, okay? This wasn't. This was 75 days, tabled in summer when everybody's on holidays or in the fields or in their villa in France, and saying, what about, doing this? By the way, here's 27 pages of legislation to deal with, because we know you don't want to do anything else in the summer. But to explain it for you, we're going to include another 47 pages of explanatory notes and 63 pages in the report, so 157 of summary pages. Oh, sorry, I forgot the 20 PowerPoint slides to go with that. That was what came out of finance, and just put in perspective, the this Chartered Professional Accountants of Canada, along with the Canadian Bar Association, their joint committee recently submitted over 167 pages of problems in their 27. So where we are right now. So one of the things that I've left for you at the back to pick up as well, if you haven't picked it up already, is talking about the changes that will affect farms generally speaking. So we're not going to get into the passive investment stuff or other small business type stuff at this point. I apologize, it was kind of short notice, so I'm kind of having to go off some Cole's notes because I didn't have this rehearsed at all, and I'm sure my colleagues are making fun of me in the back, so that's fine. And I'm a little camera shy for those that know me, but I hear, yeah, right. Basically, there's changes involving lifetime capital gains deduction, okay? What's going to happen is as of January 1st of 2018, if you want to use your child's lifetime capital gains deduction on eligible farm property, so farmland, partnership interest, qualified small business shares that relate to or qualified farm corporation shares, I should say, sorry, family farm, there's going to be some issues there. So you will no longer be able to realize a capital gain to use any lifetime capital gains deduction for minor children in the new year. Minor children will not be able to use it on the appreciated value of the farm property that built up before their 18th birthday. So this means that for any qualified farm property that the farmer has not yet transferred to their child, they should consider using up the capital gains deduction up to the value at the time the child turned 18. So how many of you have more than one child in your household? More than one kid? Doesn't surprise me at all. How many times do you want to evaluate your business? Because you get to do it, if you're really trying to do it correctly, you want to do it every time you have a child that turns 18. Because you can't use your exemption on the pre-amount that's grown. So now your costs have just gone up because every child that you have, you need to have an idea as when it's, hey, happy birthday, what's our farm worth? Good luck with that. So that's the rules will be very difficult and expensive to follow in comparison to the current tax rules where there is no such restrictions. The requirements and costs of valuation and appraisals on each child's birthday could get frustrating and expensive. All capital gains allocated from a family trust will no longer be eligible for the capital gains deduction. So for those of you who took advantage of setting up family trusts for other non-tax reasons, you'll need to weigh the benefits of the tax reasons versus the non-tax reasons, such as probate planning, in-law you don't like that might be trying to stake your kids' assets, things like that, divorce protection, which isn't always perfect but sometimes works. Or a living will is another way we might call it. So those of you who have family trusts, definitely talk to your tax advisors and deal with that because you may be looking at winding up the trust completely if the non-tax reasons are really not there and it was mainly tax motivated if these laws go into effect. Capital gains realized on the qualified farm property other than farmland, so partnership interests and shares, earned by any individual who is related to the farmer will now be subject to a reasonableness test. So somebody tell me what the value of reasonableness is. I'm hearing crickets. The reality is that it's subjective, right? It's what I think versus what you think, and if you have a bigger stick, you win. So any portion of the gain that falls in this subjective test will be taxed at the highest tax rate, with no consideration for personal tax credits or other tax brackets. So think about that for a second. If you have $5,000 of this gain that is no longer considered reasonable because it was allocated to a person that they didn't think should have got it, and that's their only income for the year, they're paying tax at the same rate as somebody who makes over $300,000 in Alberta. So that's a little steep. 48% is the regular tax rate on that, so 24% would be capital gains if it was a gain, but if they deem it to be the dividend, depending on which rule will apply under these new rules, then it would be 41.3% on $5,000. So that's a quick $2,000 going to the government just for the purpose of giving $5,000 to somebody that shouldn't have got it, is what they think. They will require analyzing all contributions made. So the reasonableness test is not just how much. They want to look at, well, what kind of labor did they put into it? What was their past earnings? How much assets did they put into it? How many risks did they assume? How much influence did they have? Influence? I got a kick out of that one. I'm trying to figure out how to put a dollar amount on influence, because I tell you right now, my wife's got a lot of influence over me. So what's her dollar? So really, she should be getting 100% of the dividends, because I think she's got all the influence of my business decisions. They will require analyzing all contributions made, all compensation received by the individual over all the years they were involved in the farm. So right now, the legal requirement to keep books and records is 6 years from the date of assessment. In the accounting community, we basically refer to it as 7 years because of a rolling date from your assessments. So we say, you know what, keep your records for 7 years. After that, have a bonfire, enjoy. This is saying for as long as you've been involved in the farm. And since we're dealing with capital gains, that means that goes back to 1972. So how many people here have a farm that's been passed down since 1972 that has every single tax return and every single contribution that's been involved and every single work that you've done for that farm documented? Bueller? No, okay. Sorry, I like to put humor in it because I put as a tax accountant, we're really exciting people. Sometimes I've been told I put the fun in funeral, but anyways. Wow, tough crowd. So proposed. So that's the problem we see with the capital gain side of things is that you're now trying to put a reasonableness test on value and how you got there, how the value of the farm has gone up over the years, the equity that's come up, how you've grown the operation, and then saying, well, how much of that value is related to risk? How much of that value is related to the influence? How much value is related to what you did? And then saying, well, you're all related, so we need to figure out that percentage. So if you don't have a formal partnership agreement, common law dictates that it's 50-50. You share 50-50 profits, husband, wife, small farm operation, 50-50 business statement, everything's simple. But now they come back and say, well, prove it. So legally, you're supposed to report 50-50 because that's what you earned. But they're going to say, well, we think it should have been 70-30. And so, yes, this guy's going to pay tax on that 70 or on the 50 that he reported. That's no problem. But the person that was only supposed to be allocated 30 that's now allocated 50, well, that extra 20%, we're going to turn around and we're going to tax them at the highest tax rate because that was tax on split income. So even though you're required by law to report it as 50-50, for tax purposes, they're going to come back and say, oops, you're wrong. So that's problematic. So beginning on January 1st, 2018, income splitting with your relatives will be subject to various restrictions. The existing rules for minors, so some of you may have heard of this as what was sometimes called the kiddie tax. So this was brought back in 2000, and to a certain degree, rightfully so. The tax community, we were a little, miffed by it at first, but yeah, I don't think a 2-year-old child should be getting, a very large dividend and us being going, and paying no tax. So it made sense. So for a minor to get a large dividend, they said, if you're getting it from a private related company, it was a pretty bright line test. It was, here are the facts. It's a minor child, they're related to the owners, they're a shareholder, they're getting a dividend, we're going to tax them at the highest rate, no personal tax credits. Pretty black and white, no areas of gray. The problem, and then they eventually expanded that, even on our friendly party, which I won't refer to because I don't want it to be a political thing. Brought in the rules to expand that to capital gains, and most of the tax community, again, we grumbled, but it made sense. This, however, goes into a whole nother level because it's not a black and white test. These rules now extend to related adults, not just the kids, with many complexities being introduced, not the least of which a reasonableness test. Splitting income with your spouse, adult children, adult grandchildren, brother, sister, parent, grandparent, and new for 2017, uncles, aunts, nieces, nephews. Under the tax on split income rules, not for all the other transactions that deal with related parties, just the tax on split income rules, they've expanded it to include uncles, aunts, nieces, and nephews will be subject to a reasonableness test. The common sources of farm income, such as wages, partnership income, and dividend income from the farm corporation, will be included in the reasonableness test. Income splitting with a non-active spouse or non-active children, or non-active relative for that matter, is not advisable under these proposed changes. I cannot stress this enough because the tax rates are punitive. So if you are I wrote a little article to kind of on LinkedIn for those of you who are savvy enough to follow tax nerds on LinkedIn. I wrote a little summary article about a partnership scenario with a husband-wife, small business. They make 50 grand, and they go to their accountant and they say, okay, we made 50 grand this year. He's like, great, what else did you guys do this year? Well, we decided to have a family, we had a baby, I stayed home a little bit when I was breastfeeding, couldn't exactly do as much at the office. So, I stayed home a little more. Well, we've got a problem because we can't give it to you 50-50. What do you mean? It's a 50-50 business. They only made 50 grand, 25 grand each income, have a nice day, you're in the lowest bracket. And that's where he said, we're going back to the effort, amount of time involved, amount of risk involved, and that's when we now say we've got a penalty. We've got, in essence, a penalty. It's a higher tax rate, but it's punitive, to the point where the analysis provided by the Joint Committee on Taxation from the I can't even say my own designation, how bad is that? Chartered Professional Accountants of Canada and the Canadian Bar Association pointed out that this rate from the low income side, the tax on split income, is a 2,500% increase on their taxes. 2,500. So if you'd like some light reading on that one, how's that targeting the wealthy? There is a special election in 2018 dealing with the capital gains deduction for this child, where they can utilize up to their full $1 million on eligible farm capital gains. They will be subject, however, to a prepayment of tax called alternative minimum tax. And for those of you who have had to use capital gains deduction on your farms in the past as a lump sum and you couldn't defer it at all, you may be familiar with this tax that you weren't expecting, and you probably got mad at your accountant because it's our fault. This tax is only refundable against a portion of future personal income taxes owing over the following usually 7 years on earned income, as in a kind of a use it or lose it scenario. So after you've paid your minimum tax resulting from this 2018 election, the individual has to earn enough income in the future to recover it. So where we see this a lot being bad is with retiring farmers who are trying to use up their exemptions as they pass it on, because they're not going to have any active income after that. And so they're going to end up with this prepay of this minimum tax, and it'll be hard to recover it. So sometimes what we've done is found ways to pay grandma and grandpa as they leave, but now that will be subject to the tax on split income rules, which means we can't do that either. So if they earned, to put it in perspective, if they earned $40,000 in employment income over the next 7 years after they've sold, so if they use the full $1 million, it'll end up being about $50,000 of minimum tax, okay? And if they earn 40 grand in employment income over the next 7 years, they still would not earn enough income to recover all that minimum tax and would lose approximately 10 grand of it. So for young children, the likelihood of earning income enough to recover this minimum tax is even more unlikely. So under current rules, what would we do? We would sometimes use what was called a capital gain deferral. We'd use it over multiple years to reduce the size of this minimum tax. However, this is not the case under the proposed 2018 election, because the entire gain and deduction all has to occur in 2018. This would create the largest AMT amount with no deferral opportunity, and we're hoping that maybe Monday's meeting is to fix this. If you're listening, Bill, that's you. Monday morning, fix that. If the child receives qualified farm property under the existing farm rollover rules, and the child elects to utilize their deduction in this supposed to be saving provision in 2018, there is an existing tax trap, and my colleagues will know about this one very well. Subsection 6911. For those of you who have a little, you know that the subsection, anytime you see subsection 69, somebody's getting screwed. If they have not owned the qualified farm property for at least 3 years before they elect, they will fall into this trap. So what happens is if somebody transferred property to you or to the child in 2016, they're going to be caught because they will not have owned this property for the full 3 years yet when they trigger this new election. And so that what happens in that scenario is that it would actually result in full taxation of that gain back to the parent who transferred the property, who they thought they were sheltering this gain using the child's deduction. So the child can't use the deduction, the gain goes back to dad and mom, and they get to pay tax at the full rate. The election will allow minor children to use up their capital gains deduction on qualified farm property, but not on shares of farm corporation. For that, the minor children must sell their shares to use their capital gains deduction. However, adults should not have this restriction. While electing to realize capital gains in 2018 will avoid the reasonableness test for the gains realized until the end of next year, it will attract this alternative minimum tax, but it will also impact other income-tested benefits that people may not be aware of. This will impact the Child Canada benefit, Alberta Family Employment Tax Credit, Working Income Tax Benefit, Refundable Medical Benefit, Guaranteed Income Supplement, potential clawback of old age security, and the GST and HST credit, which bases it on your household income. In other words, realizing a capital gain just on paper to save future taxes will cost you in some benefits today. I find it interesting that whenever the government wants to give us money on a benefit or a tax credit, they look at household income. And yet whenever they want money from us, they look at us as individuals. Something that has a bit of a disconnect there in the tax system. And if we go back to the Carter Commission, they actually did recommend in the 60s that we should be looking at the household as the economic unit and not the individual. Risks in setting up a farm corporation. So for those of you who are considering setting one up and you haven't yet, as if these changes are not complex enough, the proposed changes can also include a very broad, or they do include a very broad, anti-avoidance provision intended to prevent transactions that converts a dividend from a company to another form of income taxable at a lower rate. These proposals are broad enough that they could actually apply in a common situation like selling farm assets to a corporation. These proposals will cause significant tax uncertainty for farmers who are considering incorporating their farm. So you might be thinking, well, we're just going to sell the tractor and all that to the company, take back a note, and I'll have to pay a little bit of recapture or whatever on my tax return. Well, that could be a problem. What can you do? Well, under these proposed changes, there's some things to consider as you plan ahead. Will your farm have an issue under proposed changes with capital gains on qualified farm property? If it's so, please review this with your professional advisor to ensure your farm properties qualify for the capital gains deduction. Because if they don't qualify, you should plan as soon as possible so you can meet it by the end of this year. That way the farm properties will be eligible for the special election if you want to use it for next year, and you can avoid the restrictions under the proposed new rules that begin then in 2019. If finance decides to fix the issue with what I referred to there, subsection 6911, which is the 3-year holding test for this election, and you've already considered transferring some of your farm property at a value below fair market value to an active or non-active farm child, then consider transferring it before the end of this year. This could allow the child to utilize their capital gains deduction in the proposed 2018 election, but only if they fix this issue. So right now, if you were to do that, you'll get caught by this 3-year holding test. If they say, you know what, we're going to ignore the 3-year holding test for the purpose of this election, which they didn't put in the legislation yet, then go ahead and do it. The problem is, what are the chances of us finding out by New Year's Eve? Or them getting it fixed by New Year's Eve? I don't know. And they're not going to let you say, oh yeah, you can transfer it later in February. If you have family trusts in your farm structure that was strictly tax motivated, as I said before, consider unwinding the family trust. However, you may have significant non-tax reasons for keeping it, and so you should review your options with your advisors because the non-tax sometimes outweighs the tax. Before transferring any farmland to an adult child or grandchild, under the current farm rollover rules, the landowner should consider using their capital gains deduction up to the value of the qualified farm property at the time their child or grandchild turned 18. This is because when the child or grandchild will not be able to use their own lifetime capital gains deduction up to the value of the land on their 18th birthday. So all the value that's gone up, that the farm has increased until they turned 18, that value cannot be sheltered by exemption by the child on their tax returns. So you need to look at seeing if you have enough to shelter it first. Perhaps the landowner must be careful, however, when they're transferring to a grandchild because of the time differential as to when the appreciated value in your farm, because the landowner may not have enough deduction for the land value appreciation up to when the grandchild turned 18. Perhaps the grandparent should transfer the farmland to the next generation first, which is the grandchild's parents, to utilize the parent's deduction on the portion of land appreciation that occurred after the parent turned 18 prior to the grandchild turning 18. So basically I'm saying the grandchild didn't come first. So I think we got that whole chicken and egg thing figured out somewhat. But at the end of the day, you want to look at how we're going to transfer it through. If you're sitting on the property and you're looking at passing it off through to the grandchildren's to take it over, obviously there's 2 generations there of growth in value that you're looking at, and so we're saying we might need to stagger that role in order to use up both generations' deductions, because if you flow it all at once, we might have a problem. So there's no doubt that these rules will be difficult and expensive to follow in comparison to the current tax rules. I didn't even get into the passive investments in a corporation, and so I can definitely talk for length. I have no problems talking, that's for sure. The reality is, I like to hear myself talk, that's what tax nerds do. But the reality is there's a lot of changes in not just the farm situation, but I'm sure you've heard of small business, income splitting, partnerships, things like that. And if those other areas apply to you, I'm more than happy to have that discussion with you as well. If your farm business operates as a farm corporation and has built up significant sources of cash and related investment income, like a stock portfolio or GICs, so be aware that finance is also considering additional complex tax changes affecting investments in passive income to where your cash-in genes effect could end up being a 73% tax. A lot of murmurs on that one. So talk to your advisors if you're planning to restructure your farm business this year, if you've transferred farm property to a child or grandchild, or considering it, if you've received farm property from your parent or grandparent or considering it, and definitely, just go and have that meeting, because the sooner you have that discussion with your professional, the sooner you can maybe get some of these issues dealt with. The problem is we have a lot of uncertainty. And so your professional, you might be frustrated when you go meet with any professional, because we're going there saying, well, we don't know what we should do. And the issue is that the legislation was issued in draft. It hasn't even been tabled in Parliament. It hasn't even been read in Parliament. It hasn't passed any level of the House. It hasn't received royal assent. But by golly, the finance minister said it, so we should consider it law. And if you think I just said something that's hilarious and why somebody would come across as whatever I say is law, and that we should be following that in Canada, we do. Every budget document that comes out is effective the date of the budget, but it hasn't been passed yet. So we act as though things are law when the minister opens his mouth. And that is something, as tax practitioners, we have to file tax returns in real time. We can't wait for things to go through the bureaucracy of passing in the government, so we have to assume it will be law. We don't have the ability to look at things in retrospect, but when your auditor comes in 2 years and they've figured out how they're going to review this thing, they do. Right? Your professionals are trying to help you today with as much limited information as they have. The CRA is not allowed to comment on draft legislation. They can't say how they're going to administer the act. Finance comes up with the laws. It is up for the CRA to administer them, and it's up to the courts to interpret them. So if your accountant is going like this, there's probably a reason for that, because we don't know. We see, this is the most backlash we've seen on proposed legislation in a very long time. We think that the subjective tests are immense and actually cause more uncertainty in the act. And as professionals, we don't want that. How often do you hear somebody standing in front of you saying, "Don't pay me more money to work"? That's what we're saying. How weird is that? Chartered professional accountants, we're sitting up here saying your fees are going to go up because it's so complex. We're going to have to spend more time on your files. You're going to have to spend more and hire more staff to deal with this stuff. You're going to have more administrative costs. We think this is ridiculous, and so we're pushing back. But we're just protecting our wealthy clients. No, we're trying to make our lives simpler, because we have a tough time selling our bills to you already, right? You guys don't like us. We're the necessary evil in your life. And we're trying to look at it and say, how do we help our clients? At the same token, how do I make a living that I can at least enjoy my life? And I don't want to be the guy that's telling everybody this is the problem and this is your bill and this is how it's going to go when all these changes are going through. And so it's kind of funny that when we're being accused of supporting the wealthy client and we're actually arguing against our own income. So anyways, I will stop it there for now. I'm sure there'll be many questions, but I don't have all the answers. I'll be very blunt. I am a tax nerd, and I'm proud to say that. And I am viewed as an expert in the field. However, this is all brand new for all of us. We've had a very short time frame. We've had a lot to soak in. There's probably things I've missed. I'm sure my colleagues might be able to speak to some of those if they are more than welcome to. And you know, there's things that we need to focus on. But the key is be aware this stuff is big. This isn't a little thing that we should just say, oh, it's a tax change. You know, my accountant will figure it out. It's a big deal, and so we need to plan ahead for these things.